Hello, I'm Rob Goff, Head of Research for Echelon Wealth Partners. Our team of 7 highly accredited analysts brings north of 70 years of capital markets experience to bear in their coverage of over 70 Canadian names. Our research team maintains its top pick portfolio as a showcase for their best recommendations. As we pause at the mid-year to review that portfolio list, we are very pleased to announce that we generated a return of 52% for the first half, significantly outpacing the 10% return across the broader TSX. If you take away the 243% gain associated with Ryan Walker's Kaminak with the May takeout, the remaining 7 names generated a very impressive 25% return across the period. Taking another look at it, 7 of our names outperformed the TSE bogey at 10%. The lone exception was DHX Media, which was down by a modest 1% over that first half. DHX Media has been a long-standing member of our top pick portfolio, introduced in 2014 with our inaugural list. Over that period, the stock has generated a return of 40% for investors. As such, we are maintaining DHX Media within our portfolio, confirming our $12 price target on that name. We are very pleased that our first half outperformance builds on a history of outperformance. Looking to 2015, our top pick portfolio generated a return of 7% against a market decline of 11%. Looking further back to our inaugural year of 2014, our portfolio generated a return of 38% against a broader market advance of 7%. In terms of the broader market, we were very pleased to see the 10% gain on the TSX largely erased the 11% decrease experienced during 2015. We're more pleased to note that the TSXV generated a return of 42% on the first half that largely erased the losses of 50% experienced across 2014 and 2015. Going into the year with our top pick report, we discussed the underperformance of small caps. We discussed our view that the underperformance led to a situation where the small capitalization names were significantly undervalued. We looked to private equity, we looked to M&A activity to close the gap. We also came into the year with a bullish call on gold that has proved to be spot on the mark. When we look at the TSXV, the materials index has gained an impressive 106% for the year to date, taking the materials weighting up to 57% of that index. Our call there and Ryan's recommendations have clearly worked out for investors. Without going further, I'm very pleased to hand it over to our individual analysts as they will talk to their top picks.
Hi, my name is Ryan Walker. I'm the mining analyst at Echelon Wealth Partners, and today we're introducing Victoria Gold as our top pick for the second half of 2016. We recently initiated coverage of Victoria with a speculative buy rating and a 90-cent price target. So really, Victoria just fits the bill for what we've seen as far as M&A activity within our coverage universe so far. In the last 18 months, we've had 4 names taken out by M&A activity. That's Probe Mines, New Strike Capital, Remarco Minerals, and most recently, Kaminak Gold. So what is this template that we've seen emerge? Well, it's simply a multi-million ounce deposit anchoring a large district scale land package with exploration upside. And that's exactly what Victoria has at its Eagle project in the Yukon. It's got 2 million ounce reserve right now, and that's contained with a 6 million ounce resource, and that all anchors a 555 square kilometer land package. But what really sets Victoria apart from its development stage peers is that the project's fully permitted and shovel ready. And that's just something that can't be overstated in the current market. We've seen ever extending permitting timelines and more onerous by the year permitting requirements. Now you layer on top of that what we've been seeing increased M&A activity, picking off what little quality development targets there are out there, a general lack of exploration by mid-tiers, majors, and the juniors for the last 4 or 5 years with capital drying up for those companies. And really, we see the scarcity value of Victoria's Eagle project ever increasing. Layer on top of that, major miners and mid-tier miners, share price appreciating, going through the roof this year with gold climbing higher. They've got the capital, the paper to spend on projects which they haven't been developing in the pipeline themselves. So looking forward, the biggest near-term catalyst for Victoria Gold is an updated feasibility study in Q3 of this year. And really that has the potential to deliver some improved economics to the project. Most importantly, we've seen the development of the Olive high-grade zone about 2 kilometers away from the main Eagle zone at the project. It's a higher grade resource, about north of 1 gram per ton, and that compares with the existing life of mine average grade of about 0.8. So it makes a huge difference in a low-grade deposit. We also have the potential for lower OPEX on lower oil prices. The previous study used about a $90 Canadian per barrel versus we're at about 60 now. We can see lower CapEx, and that's just owing to general slowdown in the market in the mining sector. And we'll also see the application of a more favorable Canadian dollar gold price. Previous study used about $1,440 per ounce, compared with now we're at about $1,750 per ounce Canadian. So all of that combined should see the project economics improve and push the project into the center of any M&A screens out there among the mid-tiers and majors, and push the share price along with it.
Hi, I'm Doug Lowe. I'm the Healthcare and Biotechnology Analyst at Echelon, and our top medical technology pick this year is a Quebec-based hospital capital equipment developer called TSO3. Until recently, TSO3 had experienced valuation enhancement through development milestones for its lead ozone-based sterilization platform called VP4. But this year, the company is transitioning nicely into being a commercial stage medical technology developer, achieving substantial regulatory milestones in recent years, including US FDA approval, among other rest of world approvals. We expect the company to transition into strong revenue and EBITDA generation in the second half of this year, building on strong shareholder and regulatory milestone returns achieved in first half of this year, building smartly on backlog build and eventually strong unit sales growth for the aforementioned VP4. Our drug development top pick for 2016 is an Ontario-based dermatology-focused drug developer called Cipher Pharmaceuticals. The firm was actually spun out of a laboratory services provider many years ago called CML Healthcare, and was actually a drug delivery technology pure play during its early days, building out a comprehensive, diversified product portfolio until it identified a lead dermatology asset branded as Absorica in the US that turned out to be its flagship product, certainly justifying the company's now focus on the North American dermatology market. The company made a strategic decision to expand its own marketing infrastructure in the US with a strategic acquisition of a private version of itself called Inacutus, which we believe can be an important strategic asset for the firm, not only to sell legacy dermatology assets that Inacutus brought to the portfolio, but also to bolt on new product acquisitions in order to build out the brand leverage that the company already has in place with Absorica. And we expect strong revenue growth in 2016 to translate into strong profitability growth in 2017 and thereafter.
I'm Rob Sutherland, Echelon Wealth Partners real estate and REIT analyst. We are reiterating Pure Industrial REIT, or Pirate, as our large cap top pick for the real estate sector. Pirate saw a 22% total return in the first half of the year, and we expect continued strength through the rest of 2016 and beyond. Following a significant equity raise during the second quarter, the REIT decreased its overall leverage, further de-risking its already sound financial metrics and debt profile. Pirate's extensive development pipeline will continue to create growth for the REIT, while substantial dry powder, the ability to sell non-managing interests in large subsections of its portfolio, and strong JV partners allows for almost any level of growth for external acquisition. Our small cap top pick also comes from the industrial subsector. Edgefront REIT, an approximately $73 million market cap REIT, acquired over $50 million worth of property in accretive deals through 2015, without tapping the equity capital markets, by convincing vendors to take back REIT units at a premium to the then trading price. We expect the REIT to do similar transactions in the future. Edgefront owns predominantly single-tenant, triple-net lease properties with exceptionally strong tenant covenants, all tied to long-term debt commitments. This equates to highly de-risked, stable, and escalating cash flows, coupled with constant, fixed debt costs, or more succinctly, something approximately an inflation-protected bond yielding almost 9%.
We are very pleased to confirm DHX Media within our top pick portfolio list. The market capitalization is circa $970 million. Our price target is $12. We've been long-term supporters of this name, having included it within our portfolio since 2014 and been bullish prior to that. We've been drawn to the name by the compelling business economics. It starts with its core, animated children's programming. When we look at it being animated, that means it goes across linguistic boundaries. It's great for export markets. When we look at it being focused on the child or the children's marketplace, that means an extended brand life. We see brands such as Teletubbies having a life of circa 20 years. When we look at the economics here, before a production is greenlit to go, in excess of 90% of the costs associated with that production are covered off by virtue of tax credits and by virtue of selling the domestic rights to that production for a period of 4 years. That leaves DHX Media free to take the product and sell it across the rest of the world or 90% of the marketplace. The next step here in the value equation is distribution. And here, DHX has a global platform. It is clearly a seller's marketplace when you look at the demand for content by virtue of Netflix and Hulu. These two and the legacy buyers are bidding up prices on new production. They're bidding up the values on library. The bullish thesis on content drives its strength in the demand. We then look at merchandising and licensing as a great option for the company. When you get a brand firmly entrenched with the consumer, you introduce your consumer products. A company such as DHX Media could realize a royalty of circa 5% of the retail selling price. When we look at the re-emergence or reintroduction of Teletubbies, that brand could drive merchandising licensing revenues in fiscal 2017 and thereafter. We're looking at a bullish content thesis here, supported by strong execution. This is the organic growth profile, but there's more to it than that. We see further growth through acquisitions. To look at acquisition economics, DHX Media can buy a library, put it onto its platform, and experience real revenue synergies. In summary, we are very bullish on the name as long-term supporters.
Hi, I'm Andre Cornetta. I'm an analyst at Echelon Wealth Partners. I cover the technology space. Today we're talking about our top pick, Texas. The ticker is TCS. We have a buy recommendation, $11 price target. Texas is a $120 million market cap company headquartered in Montreal. They're providing supply chain management software. Their offerings derive cost efficiencies by streamlining inventory management for warehouses and U.S. healthcare distribution networks. There are two key factors that underline our thesis of margin expansion-driven earnings growth, set to outperform that at closest peers. One is converging revenue growth catalysts, which include a new product cycle, moderate recovery in their non-healthcare space markets, and total addressable market expansion. The company is launching a new pharma-based supply chain product later in the year. The second is the company is at a trough of an investment cycle. The recency of investments allows them to reap the benefits on the top line while holding their expenses constant. The resulting margin expansion is set to drive their earnings growth at 25% annual rate over the next 24 months, vastly outperforming that at its closest peers.
Hi, I'm Amr Izzat. I cover diversified industries at Echelon's Montreal office. Our top pick for the second half of 2016 is Calgary-based Pure Technologies. Ticker symbol is PUR. We have a $7.25 target price, which equates to a total return of 24%. The company provides tools and technologies to help clients assess and inspect water, wastewater, and oil and gas pipelines. The investment thesis here is threefold. Number one, the state of pipelines in North America is rapidly deteriorating, and municipalities do not have the budget to replace these pipelines. That's where Pure comes in. Pure helps customers extend the life of their pipelines by enabling clients to replace only the parts of the pipeline that need replacing. Number two, it is a high barrier to entry business with no significant competitors of size. And lastly, with a high fixed cost and strong revenue growth, we see tremendous operating leverage in the model, driving best-in-class earnings growth. In terms of catalysts, After a lackluster 2015 where the company was focused on integrating acquisitions, execution is top of mind for investors. Stock performance will be driven by the company's quarterly results, where we expect organic growth rates of 20% plus and see significant EBITDA growth.
Hi, my name is Fadi Benjamin. I'm an equity research analyst with Echelon Wealth Partners. I cover special situations. My top pick is Exact Earth, XCT on the TSX. We have it with a speculative buy and $2 price target. Exact Earth is a Canadian technology company headquartered in Cambridge, Ontario, and has a deep aerospace pedigree, having been part of the former ComDev. Exact Earth is a leading provider of global maritime vessel data for maritime situational awareness. It does so by detecting VHF ship broadcasts known as AIS transmissions from space, using its satellite constellation and associated ground infrastructure. Our thesis is based on the company's ability to acquire market share in the largely underserviced and growing maritime information market. The company technological advantage sets it apart from competitors by offering a high-quality, low-cost alternative to ship detection and tracking, especially important in areas of high ship density, like congested shipping lanes, as well as in detecting small fishing vessels. The catalysts that we see unfold in the near term include the introduction of a suite of data analytic tools that will further expand the company into offerings of higher value. The maiden launch of the Iridium Next constellation with Exact Earth hosted payload that will deliver real-time global coverage by 2017, and gaining traction in the vessel detection, in the small vessel detection, targeting the fishing industry to help deal with illegal, unreported, unregulated fishing activity. In summary, the company's competitive advantage, market opportunities, and the near-term catalysts support our view that the current share price presents an exceptional entry point with limited downside risk and strong upside potential.